You know what keeps me up at night? It's not the headlines. It's not the talking heads on financial television telling you everything's fine. It's the silence. The deafening silence from the people who actually move markets while everyone else is distracted by the noise. Because right now, while you're watching this, something extraordinary is happening in the precious metals market. And I'm not talking about some minor price fluctuation or a temporary trend. I'm talking about a fundamental shift in how the world's largest institutions are positioning themselves for what's coming next. Let me paint you a picture. 3 months ago, central banks around the world purchased more gold in a single quarter than they have in over 50 years. Not since the collapse of Bretton Woods have we seen this kind of coordinated accumulation. The People's Bank of China added another 40 tons to their reserves. The Reserve Bank of India quietly purchased 27 tons. Poland, Singapore, Turkey, they're all moving in the same direction. But here's what makes this different from every other gold rally you've seen in your lifetime. They're not buying paper gold. They're not buying ETFs or futures contracts or any of the financial instruments that Wall Street wants you to believe are just as good as the real thing. They're demanding physical delivery. They're taking bars out of London vaults and shipping them home. They're building new storage facilities. They're acting like people who know something the rest of us don't. And maybe they do. Because when you look at what's happening beneath the surface of these markets, when you actually dig into the data that nobody's talking about, you start to see a pattern that's both fascinating and terrifying. The COMEX, that's the exchange where gold futures trade in New York. They're sitting on the lowest inventory levels relative to open interest in their history. Think about what that means. You've got more claims on gold than there is gold to deliver. It's like a bank that's issued more deposit receipts than they have money in the vault. Now, most of the time, that's fine. Most futures contracts get settled in cash. Traders don't actually want the metal. They just want to speculate on the price. But what happens when that changes? What happens when the people holding those contracts start asking for delivery? We got a preview of that in March of 2020. Remember when gold futures were trading at a $100 premium to physical gold? That's not supposed to happen. In a functioning market, those prices should be nearly identical. But they weren't, because there was a scramble for physical metal that the paper market couldn't satisfy. Refineries were shut down. Transportation was disrupted. And suddenly, all those paper claims on gold looked a lot less valuable than the actual metal sitting in a vault. That was a temporary disruption, a brief moment of stress in the system. But what we're seeing now is different. This isn't a pandemic shutdown. This is a deliberate, coordinated move by the world's most sophisticated financial players to get their hands on physical precious metals before something breaks. And they're not alone. Family offices, those are the private wealth management firms that handle money for billionaires. They've been quietly increasing their precious metals allocations. Not by a little bit. We're talking about moving from 2 or 3% of their portfolios to 10, 15, even 20% in some cases. These are people who have access to every investment opportunity in the world. They can buy anything. And they're choosing gold and silver. Why? Well, let's talk about what they're seeing that maybe you're not. Let's talk about the dollar. Not the dollar in your wallet or your bank account. That's still spending just fine at the grocery store. I'm talking about the dollar's role as the world's reserve currency, the thing that's underpinned global trade and finance for the last 80 years. That system is cracking. The BRICS nations, Brazil, Russia, India, China, South Africa, they're not just talking about creating an alternative to the dollar anymore. They're actually doing it. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT. They're creating mechanisms to buy oil and gas and commodities without ever touching a dollar. And every time they do that, every time another country decides they don't need dollars to conduct international trade, the demand for dollars drops. And when demand drops, value drops. It's basic economics. But here's where it gets interesting. The United States has been running trillion-dollar deficits for years now. We're adding debt faster than the economy is growing. And traditionally, that hasn't been a problem because the rest of the world needed dollars. So they bought our treasury bonds. They financed our deficit spending because they had no choice. What happens when they do have a choice? What happens when Saudi Arabia can sell oil to China and get paid in yuan? What happens when Russia can sell natural gas to Europe and settle in euros or rubles? What happens when more and more international trade happens without dollars? The answer is simple. Those dollars come home. And when they do, when all that currency that's been circulating overseas for decades suddenly floods back into the domestic economy, you get inflation. Real inflation. Not the kind where your grocery bill goes up 10%. The kind where the purchasing power of your savings gets cut in half. And that's exactly what central banks are preparing for. That's why they're buying gold. Because gold is the one asset that maintains its value when currencies fail. It's been true for 5,000 years, and it's still true today. Now, I know what some of you are thinking. You're thinking this sounds like doom and gloom. You're thinking maybe this is overblown. Maybe the system is more resilient than I'm giving it credit for. And maybe you're right. Maybe the dollar maintains its dominance for another 50 years. Maybe the BRICS nations never get their act together. Maybe central banks are wrong and they're wasting their money on gold. But here's the thing. You don't have to believe any of this is going to happen to understand why precious metals make sense right now. You just have to look at the math. Global debt is at record highs. Government spending is accelerating. Central banks are trapped between fighting inflation and supporting economic growth. They can't do both. And when they're forced to choose, they're going to choose growth. They're going to print money. They're going to keep interest rates lower than inflation. They're going to devalue the currency. That's not a conspiracy theory. That's stated policy. The Federal Reserve has explicitly said they're targeting 2% inflation. That means they want your money to lose 2% of its purchasing power every single year. On purpose. By design. Over 20 years, that's a 40% loss in value. Over 30 years, you've lost more than half your purchasing power. And that's if they hit their target. If inflation runs hotter than 2%, which it has been, you lose even more. So the question isn't whether you should own some precious metals. The question is how much and in what form. And that brings me to something I want to mention quickly, because it's relevant to a lot of people watching this. If you've got $100,000 or more sitting in a traditional IRA or 401k, you might want to look into how gold IRAs work. I put together a free guide that explains the whole process, how you can get physical gold into your retirement account without triggering taxes or penalties. It's in the description below. No pressure, but if that's your situation, it's worth understanding your options. All right, back to what's happening in these markets right now. Because the gold story is only half of it. Silver is where things get really interesting. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. It's used in solar panels, electric vehicles, electronics, medical equipment, basically every technology that's supposed to power the future economy. And unlike gold, where most of the metal ever mined still exists in some form, silver gets consumed. It gets used up in industrial applications, and it's not economically viable to recover it. That means we're drawing down above-ground supplies every single year, and at the same time, mine production is flat or declining. The easy silver has already been found. The high-grade deposits have been mined out. What's left is lower-grade ore that costs more to extract. So you've got declining supply and increasing demand. And on top of that, you've got the same monetary dynamics that are driving gold. Central banks might not be buying silver the way they're buying gold, but private investors are. The U.S. Mint can't keep up with demand for silver eagles. Premiums on physical silver are running $4, $5, $6 over spot price. That's unheard of in normal markets. And then there's the paper market. The silver futures market is even more leveraged than gold. There are estimates that suggest there are 100 ounces of paper silver for every ounce of physical silver that could actually be delivered. Maybe that's an exaggeration. Maybe it's only 50 to 1. Does it matter? Because here's what happens. In a leveraged market, when people start asking for delivery, the price goes vertical. We saw it in nickel last year when a short squeeze forced the London Metal Exchange to literally cancel trades and shut down the market. We saw it in lumber during the pandemic. We've seen it over and over again throughout history, and silver is set up for exactly that kind of move. Now, I'm not telling you this to create fear. I'm telling you this because understanding what's happening gives you options. It gives you the ability to position yourself ahead of the crowd instead of chasing prices after they've already moved. Think about what happened in 2011. Silver went from $18 an ounce to almost $50 in less than 6 months. People who owned it before that move made life-changing returns. People who bought at the top got crushed. Timing matters. And right now, we're in a setup that looks remarkably similar to the period before that rally. You've got the same kind of supply constraints, the same kind of monetary instability, the same kind of institutional accumulation happening quietly in the background. But there's one big difference. In 2011, the world wasn't actively trying to move away from the dollar. The BRICS weren't a real threat to the existing monetary system. Central banks weren't buying gold at record pace. The geopolitical situation was completely different. This time, all of those factors are aligned in the same direction. And that's what makes this moment so significant. Because we're not just talking about a commodity rally. We're talking about a fundamental repricing of monetary metals in response to a loss of confidence in fiat currencies. That's a much bigger story. That's the kind of thing that drives decade-long bull markets, not just 6-month spikes. And the evidence is everywhere if you know where to look. Look at what's happening in the mining sector. Gold and silver mining stocks are trading at valuations we haven't seen since the bottom of the market in 2015. These are profitable companies, generating free cash flow, sitting on valuable assets in the ground, and they're being valued like they're going out of business. Why? Because investors have been burned before. They remember 2011 to 2015 when precious metals crashed and mining stocks got destroyed. They're skeptical. They're waiting for confirmation. But that's exactly when the best opportunities exist. When everyone's skeptical, when valuations are depressed, when the fundamentals are improving but sentiment hasn't caught up yet. The smart money knows this. That's why you're seeing insider buying at mining companies. That's why private equity firms are taking miners private. That's why major producers are acquiring junior miners at premiums. They're positioning for what comes next. And what comes next is a repricing of these assets that's going to shock people who aren't paying attention. Because here's what most people don't understand about precious metals. They're not an investment in the traditional sense. They're insurance. They're a hedge against the failure of the monetary system. And the premium you pay for that insurance looks really cheap right now, compared to the risk you're insuring against. Think about it this way. If you own a house, you pay for homeowners insurance every year. You hope you never need it. But you pay the premium anyway because the cost of not having it when disaster strikes is catastrophic. Precious metals work the same way. If the dollar maintains its value and the monetary system stays stable, your gold and silver will probably just keep pace with inflation. You won't get rich. But you won't lose purchasing power either. That's the floor. But if things go the other way, if we get a currency crisis, if inflation spirals out of control, if the dollar loses its reserve status, then precious metals become the most valuable assets you own. They become the thing that preserves your wealth when everything else is falling apart. That's not a symmetrical bet. The downside is limited. The upside is enormous. And right now, the probability of the upside scenario is higher than it's been in decades. You can see it in the options market. Call options on gold and silver. Those are bets that prices will go higher. They're relatively cheap right now. The market isn't pricing in a major move, but the fundamentals suggest one is coming. You can see it in the physical market. Dealers are struggling to keep inventory. Wait times for delivery are extending. Premiums are rising. These are all signs of tightness in the physical market that eventually translates to higher prices. You can see it in the commitment of traders' reports, commercial hedgers, the people who actually produce and use these metals. They're reducing their short positions. They're getting less bearish. Meanwhile, large speculators are still relatively underinvested. There's room for a lot more money to flow into these markets, and you can see it in the macro environment. Every single factor that drives precious metals higher is in place right now. Negative real interest rates, expanding money supply, geopolitical instability, currency debasement, loss of confidence in institutions. This isn't about predicting the future. This is about recognizing a pattern that's played out over and over again throughout history. When governments spend more than they take in, when central banks print money to finance deficits, when currencies lose purchasing power, precious metals go up. It's not complicated. The only question is timing. And while nobody can predict exact timing, we can look at leading indicators. We can watch what the smart money is doing. We can pay attention to the signals the market is sending. And right now, all of those signals are pointing in the same direction. Central banks are buying. Institutions are accumulating. Physical demand is overwhelming supply. The paper market is stretched thin. Geopolitical tensions are rising. Monetary policy is trapped. Debt levels are unsustainable. You don't need all of those things to be true for precious metals to do well. You only need a few of them. And we've got all of them happening at once. So what does that mean for you? It means this is a moment to pay attention. This is a moment to understand what's happening and position yourself accordingly. Not with money you need next month or next year, but with a portion of your wealth that you want to protect over the long term. Because the ultimate IRA protection plan isn't some complicated financial product. It's not a strategy that requires perfect timing or sophisticated analysis. It's simply owning real assets that maintain their value when paper assets don't. Gold and silver have done that for thousands of years. They've survived every currency collapse, every empire's fall, every financial crisis. They're still here. They're still valuable. They're still the ultimate form of wealth preservation. And right now, at this moment in history, they're offering an opportunity that doesn't come around very often. An opportunity to protect yourself before the crowd figures out what's happening. An opportunity to position yourself ahead of a major repricing in these markets. The institutions know this. The central banks know this. The billionaires know this. They're acting on it right now, while everyone else is distracted by the daily noise. The question is, will you?